Welcome everyone to Jim Dalton's presentation, Let the Trade Come to You. It's Wednesday, June 21st, 2017, 4:31 p.m. Eastern. Thank you all for being here. Great to see you. This is being recorded, so we'll have it up at jdaltontrading.com. In about 2 hours after the webinar, it'll be ready for you. Okay, so enjoy it. We'll also post it on YouTube for you. So sit back, enjoy it, and I'll turn it over to Jim. Hey, Jim.
Thank you. Thank you. Well, thank you all for being here. This is billed as a, it's educational, but it's also promotional as we're getting, trying to get the last few people for the final intensive, which starts July the 10th. In line with that, I'm going to talk about, letting the trade come to you, but I'm also going to be very specific on today's trading in the ES, and I will take a look at the NASDAQ in order to give you an idea of some of the things that we do and some of the things we look at and what's part of the educational program. All right, so letting the trade come to you, it's a concept that is very hard for people. Most people, most traders are out there constantly searching for a trade. And my point is, if you are out there searching for a trade, more than likely you're going to find a trade, but also more than likely it's not going to be the good trade. When the good trade comes along, it usually just pops up in front of you. But in order to recognize the trade when it gets there, you have to have a real in-depth understanding of the market. And most people have trouble with this concept, and you'll have trouble with the concept until one day the trade just comes to you. All of a sudden, you weren't even thinking about something, there it was right in front of you. It's like, I remember years ago when I was taking golf lessons, which I never carried through on, but I really didn't know what a good swing was until all of a sudden I hit one and I could feel it, I could hear it, I just knew I had done it correctly. Unfortunately, I couldn't do it correctly again, but I did know it when I did it. Okay, just a couple of points. In order to recognize when the trade comes to you, you have to be totally present in the market. That means that you're in front of your screen. You're not necessarily hunched over your screen, but you're back, you're aware of what is going on. You're not making phone calls. You're not taking care of other family business, yelling at the kids or, passing emails and jokes back and forth. You want to be relaxed, and you want to be in front of the machine, and you want to be able to observe what is going on in the market. One of the terms that we've introduced in the first mastery session is the term chunking. Most of you have been on one of these before, so you know what I mean by chunking, but just for fast definition, first time you back your car out of the garage, you're very cautious. You start the car, you look over your shoulder several times, you check the window several times, you go a couple feet backwards, you stop, you look again. The more and more you do that, the smoother it becomes and the more effortless it becomes to back the car out of the garage. Once it becomes smooth, that means it is something you have chunked. You have brought it all together. I'm talking about being able to do the same thing at the market. When you look at a market, instead of having to, intently study the market, you should be able to look at the market. You should be able to see where value is. You should immediately see poor highs, poor lows. You should see where value is building. And, you should see if it's one time framing. There's just things that come to you very, very quickly. The next thing to letting the trade comes to you is that you have to have extreme patience. Patience is an extremely difficult thing for traders to learn. Most traders come in with the false idea that trading is very active and it involves doing a lot of trades and you're active all the time. I have found that most people are not successful, or one of the reasons they're not, is that they overtrade and that they spend too much in commissions. The overtrading usually is very costly from the spread between the bid and the offer. It's costly from the commissions you pay, and it just wears you down. Extreme patience so you're comfortable letting the trade come to you. You probably only do a couple of trades a day, but they'll more than likely be much better trades. Letting the trade comes to you means you have to understand the market structure. And we're going to see that. We're going to see that when we look at today's market in just a few minutes. Understand what the structure is telling you. Years ago, where the market profile came from, years ago, the traders on the floor did most of their business via sound. They heard when there was noise. So in other words, if the market took out yesterday's high and the volume got very quiet, they knew that there was nothing there. It took out the high, it was just flat. They knew if you took out yesterday's high and all of a sudden the noise level went up, that meant that new higher prices were bringing in more activity. They knew that market was going higher. As they saw floors beginning to close down and had an understanding that we were going to electronic trading, the profile was really developed in order to allow you to look at the market and see what was developing rather than hear what's developing. You're just replacing one sense with another sense. When we got to the point of being able to do this, it was the development of the market profile. What the profile does, it records the market's continuous two-way auction process. So it allows us to visually see what is going on in the market. And that structure, that just as noise used to talk to the traders on the floor. When you learn to read and interpret structure, you will find that structure will talk to you, and in many cases, talk to you even louder and give you more of a warning of what is developing. Part of trading is understanding the position of your competitors, particularly when those competitors have inventory that is too long or too short. And we're going to talk about that again when we get into the some real live examples in here. It's extremely important, and a lot of people don't really appreciate what we're talking about when we say understand the position of your competitors, and particularly when it comes to inventory. But we'll see that here in just a few minutes. Next is a mental attitude that you don't have to trade. If you come in the morning and you are psyched up, you are all geared up, and you're going to do some trades no matter what, that is usually a self-destructive attitude. When you are trading well, your mental attitude is usually that I don't have to do a trade. I don't have to do anything. If something presents itself, I will become engaged in the trade. Unless something happens, I'm not going to be there. Ask yourself how many of you, particularly during the opening period, find yourself frantically searching for a trade. Is it going up? Is it going down? And you'll see again, we say when a market opens within the previous day's range, you are usually better off not to trade early because there's so much chop going on. And that was exactly what happened this morning. The market opened within yesterday's range. We had a tremendous amount of chop in the first half hour, 45 minutes. But I could see the way the market was going up and down. I know there were tremendous numbers of short-term traders getting long, getting short, and probably wore themselves out and expended a lot of mental as well as financial capital before the real opportunities in the market began to develop. Okay, let's start with some real examples in here. Let me escape from here. And what I'm going to do, I'm going to spread out today's market. And I'm going to try and walk through what took place. First of all, last night's settle was right where my cursor is. We measure overnight inventory from the settle of the previous day. If the trade takes place above the overnight settle, half takes place below the overnight settle, when we come in the morning, we say that overnight inventory is balanced. When all of the overnight trade took place below the overnight settle, we say that overnight inventory is short. We know from keeping records that about 65% of the time, there is a counter auction to overnight inventory. And by counter auction, I mean about half the time, about 65% of the time, if overnight inventory is short, the counter auction is buying to cover those shorts once the market opens. So that's something that we could talk a lot more about overnight inventory, but that's not the purpose of the day. For right now, just stay with me that overnight inventory coming into today was short. The market opens, and here is, if you're looking over on the right side, there is yesterday's settle. The green dot is where the market opened this morning. So the market opened within yesterday's range. And when I say open within yesterday's range, that also says more than likely the overnight inventory is caught short, and more than likely that we're going to get a lot of chop during the first portion of the day, as a lot of traders are going back and forth frantically looking to they should be long or short. Here is the A period. Guess what? A period is relatively narrow, takes place 100% within yesterday's range. B period is even narrower, taking place within yesterday's range, but you can see the trade going back and forth, so there's really not a lot happening in here, but traders were doing a lot of trades. We had a AB low. We consider that a poor low, and it is a poor low because there is no excess or no single prints. The high is good because there's single prints, but the low is no good because there is no excess or single prints on the low. So there's really nothing going on in this market. Keep in mind, overnight inventory is still 100% short. When I see how quiet this is in the first hour of trade, part of the educational program, we have a one-way chat. In other words, I can distribute my comments to anybody that's a client so they can see what I'm thinking, and I'm trying to, this is the best way we can come up with, I kind of mentor people through the session and do it economically. If you were one-on-one, it'd be extremely expensive. This is what we're doing, the chat. It's the best way that we can mentor a lot of people at a very economical cost. The chat I put out prior to the C period, and C period would be 10:30 to 11. The first period is going to be 9:30 to 10, 10 to 10:30. Third period is going to be 10:30 to 11. The chat comment I put out with nothing going on in the market. The EAI Petroleum Status Report, the oil report that comes out at 10:30, is likely to add some volatility to the current market. The oil report came out, you had a little hesitation, and then you did get a rally up. Now the rally up wasn't nearly as strong as how far crude rose at that point. However, you got a little pop up, and what I think happened is you got short covering. The short covering was from the overnight shorts that haven't covered. When you see the poor AB low, and when you see a poor low, that means that it's not solid. The odds of coming back through that low are very good. But many times a poor low is an indication of a market that is too short. The oil report came out, the market rallied. I believe that what that did was force the shorts to cover. Once the shorts cover, that weakens a market. That weakens a market. Okay, now the subject today is letting the trade come to you. This rally in C period brought the trade to me. I have the poor low. I know there's a pretty good chance when I have a poor low of the market coming back through that low. You get the rally in C period. That brought the trade to me. That's what I'm talking about when I say let the trade come to you. Julia, let me stop right here and see if there's any questions only relative to what I've talked about so far, please.
We don't have any questions right here, Jim.
Okay, thank you. All right, so now remember early on, we couldn't get the AB period low out. And the feeling was that the reason was I thought the market was too short from overnight inventory. Overnight inventory forced to cover. Remember, short covering can weaken a market. Now the market leaves an excess high, so we have a good high. We got single print, so that's excess, and the market comes back down through the opening and well into and below it. There was a previous gap. Let me mark. There was a previous gap here that existed from the high of the 16th to yesterday's low. The market came back down through the initial poor low, closed the gap, and some people are going to ask, well, wasn't the gap closed overnight? There's the overnight trade. The answer is no. Gaps are only closed during daytime frame sessions. So the market broke in the D period. One of the things that caught my attention was the market was unable to come down and take out the overnight low. So that's one thing. The market was unable to take out the overnight low. It may be too early, but look, when D period broke, look at all the single prints in D period. It is very unlikely that you are going to get this many single prints in the middle of a session that hold throughout the day. So again, this brought the short to me. And when you get down here with all these single prints and it spikes down here, thank you very much. That brings the cover to me. Now, do I know the market's done for the day on the downside? No, but I just know that I've got a nice trade. I know that it's unlikely to hold all of these single prints. So someplace down in here, I say, thank you very much. And I'm out of the trade. So the trade came to me on the buy side. The trade came to me on the cover of that trade. And it happened relatively quickly. So that's what I mean by a trade coming to you. And what we're trying to do is just have you get a sense of what can happen. Now, something, when I say again, this trade coming to you, there's some other important things that I haven't covered yet, but I'm going to go back over them now, and they're called the background that we look at prior to coming into the morning. Yesterday afternoon, and just to make this simpler, for right now, I'm going to take the overnight trade out of there. So we're not looking, we've already talked about that. I'm going to take that out of there for now to make this a little bit cleaner. Yesterday afternoon, we talked about, and we wrote about it last night, and we wrote about it again in the morning report. We put out a report at each evening. It's called a recap and preparation report. We update that report in the morning prior to the opening. We identified this as a price spike. We don't have a lot of rules, but we do have the spike trading rules. And the spike trading rules are as follows. Opening and remaining above the spike is bullish, as it tells you that this price probe down late yesterday afternoon was rejected. Opening and trading below the price spike tells you it was bearish, because it tells you that the prices hadn't gone low enough to cut off the selling. Trading within the spike on the following day is bearish also, because it tells you that this price spike is being accepted. If you notice, A period today opened and quickly traded into the spike. So now that shows us that the price spike is being accepted. B period traded within the spike. So it's again more information that is being accepted. So at this point in time, we have some bias, and that bias is to the downside. We always look at value. The dark or the light blue area is considered value. We trade value, not price. Price is nothing more than an advertising mechanism. The greatest filter you can have when you're trading to filter out the noise in the market is being able to observe where value is developing. Price advertises opportunity. Value is the filter that tells us, what is the real important, what is the value that's developing today. Early on in A period, we're trading below yesterday's value very early. So now we said the price spike trading in there oriented us towards the short side. As value started to build and be accepted down below the low of yesterday's value area, now we've got another indication that we are that our orientation for the day will be to the short side. We did a joint presentation with Peter Resnicek yesterday, and one of the important things that Peter says, and it's something that we say, and it is coming into every day, you should always have some idea of the scenarios in which the market may trade. When we do our reports, we always have at least 3 potential scenarios. There's nothing more dangerous than a trader that has only one scenario. A trader that has only one scenario, one thought, one place where the market's going to go, more than likely, the times he's right, he's going to be real right. But more often than not, that trader is going to be wrong, and it's going to be very painful. And when you only have one scenario, you find it's extremely difficult to give up that incorrect view. When you have 3 scenarios, in effect what you're doing is you're rehearsing. You're rehearsing what in your mind, what the market may do the following day and how you would handle that if that happened. Now there's not a department head or a CEO of any major company that doesn't rehearse a speech or a plan or anything that he's going to give in front of his audience. There's not a sports team that doesn't do substantial rehearsing. They look at game films. They rehearse the plays they're going to do. There is no reason why, if you want to be a successful trader, you don't do exactly the same thing. That is what you need to be prepared mentally. Okay, so now we have other information. We talked about some early information, but the spike rule, value building, our orientation early on is to the short side. So that makes it even easier when I say, let this trade come to me. So now the trade comes to me, I have this other information, plus I have a poor low. Poor low means that the odds of that auction to the downside having been completed are very small. So when the trade comes to me, thank you very much. It fits in with this scenario. It fits in with the value scenario. It is not a difficult trade to do. If you are only focused on price, then when this market rallies out of here following the EPI report, if all you're looking at is price, you're not going to be ready for this trade. If you are looking at structure, you're looking at how we talk and understand structure, you're looking at value, you're looking at this early information, then you're not mesmerized by this price, you're fading the price, or you're going against this price spike. When you get to that level, now the trade can come to you, and also now you are in control of your destiny in the marketplace. Very important to understand it. You trade value, not price. Okay, so now when we said then, the market got all these single prints. Well, what's that really saying? It's saying to me there was too much, too far, too fast, and what you got was a lot of emotional selling by the traders. It's just too much. And at first somebody said, well, how do you know that? Well, it's just something you experience. There's so many single prints. How did you get there? There's sell, sell, sell. That's all people are doing. Get me out at any price. So I say, thank you very much. The other side of the trade comes to me. And you see what happens. The market trades back up for, back up for several periods. I don't like these highs. I thought there was probably a pretty good chance we'd come back and take those later in the day because they're all so mechanical and also clustered together. However, let's take a look at crude so you understand what took place over here. The market rallied following the petroleum report. And what traders did, it didn't fill the gap. When it didn't fill the gap, longer term and smarter traders sold into that rally. The trend has been down. It's been strong down. The short covering in crude took some pressure off the market, allowed inventories to balance, and then the stronger traders sold back into that market and took that market to extreme lows today. When that happened, let's go back over to our market. When that happened, the market got very emotional, and traders, a lot of short-term traders, don't really think about the markets. They will trade based on crude oil. So what did they do? Short-term traders started selling. They finally got out the overnight low, and they pushed the market down. They sold it and sold it and sold it. Now, talk again one more time. Remember, at that time, we have a point of control that was still up here. Point of control is the widest point leading from left to right. It's the fairest price at which business is being conducted. Prior to this, I believe, I don't remember exactly, but I think prior to this, I'd put out a chat comment that this was when the POC, or the fairest price to do business, isn't migrating lower, then there's a really good chance that the market's getting too short or short in the hole. The emotional trading selling by the short-term traders brought the market down to the 2,800 level. When I looked at this, again, talking about a trade coming to me, at that point in time, I went delta long. And I said delta long because I used options. I used options that expire today to do it. And that market then comes all the way back up to the the original halfway point in today's range was right here. Now we're going to talk about something else because really, remember, I've been looking at all of this area up here. So when I'm talking about the trade coming to me, I'm talking about not only the establishment of the delta long, but I'm now looking at taking the trade off. But when it first comes exactly to half back and stops, and it stopped here and it traded lower. And when I look at that, I say, okay, that is not a good high. And I think I put a chat out that wasn't a good high. It was because it was so mechanical. However, once and I'm holding my position. I'm holding my position. Once it took this out and there was no follow through to the upside, I said, uh-oh, there's nothing there. And at that point in time, I let the trade go. Now, so the trade did come to me. I didn't see on the upside right away, but remember, I was fully engaged in the market. I was fully present. When this first went exactly to half back, which was also the overnight low, it was also half back from overnight. So it's a very mechanical level. Let me put the overnight back in there just to show you what these markets do. Okay, so early on, that was, let me get this out of the way, I'm sorry. It was half back from today early, it was yesterday's low, and it was just about half back from overnight. Very mechanical references. And generally, when something goes to a very mechanical level, it is not lasting because the sellers there are weaker hand sellers because they have to have something exact before they do business. So I was pretty confident. I stayed with it. It went down a little bit. But then once it traded back above it, and there was no follow through, no follow through. It's uh-oh, I have to get out of this trade, because normally what you would expect is once it trades above this reference, you would expect there to be more stops, and you'd expect it to, I would expect it to trade up into here and get the stops combined between the G, F, E, D highs, because there's going to be a lot of stops here. Very mechanical, a lot of stops there. Nothing there. All of a sudden, I had to let the trade go and book my profit. But the trade, the cover came to me. Being present in the market, being totally present in the market, knowing what I should see once I trade above this, all of a sudden I said, that's it for the trade. And that was it. That was it. The market never went back. It went a couple ticks here, went one tick here, traded there again, and then the market softened as we went into the to the close. So, that's those trades. I'm showing you what we've talked about so far. We've talked about what does it mean to have the trade come to you? It means you have to be present in the market. You have to understand structure. Without understanding structure, without understanding volume, without understanding the inventory of those you are competing against. Remember, the importance of the shorts from overnight was very crucial to understanding why I got the poor low. And once it covered, knowing that once inventory is covered, it weakens the market, and the market comes back down and easily takes out this poor low that it couldn't take out an hour ago, and just cuts through it and breaks too much. And then you see these same people you're competing against, now they've gone the other way. Now they can't wait to sell it. They're just sell, and get themselves trapped on the other side. So trading's not easy, but it is understandable. And one of the things that we're trying to do with the program is we don't think there's probably more than about 5% of the people that trade that make money. Everybody's got a lot of dreams, but you're going up against, people that have been trading for years and have weeded out the poor traders. If you are going to succeed in that arena, you need someone that is going to at least give you a framework to understand the market, understand your competitors, and trade. And it's not just a framework. It is in any profession. I don't know what, if you out there are lawyers, whether you're doctors, whether you're engineers or scientists, school teachers, or whatever you are, the people in the top of any profession understand nuances. Anybody can learn the basics of being an engineer, but it is the nuances that make the difference. I was talking to someone the other day, it was an accountant, and I said, you know, anybody can learn the basics of accounting, but it's the forensic accountants understand nuances. The nuances matter. What is buried in the footnotes matters. When it comes to trading, the nuances matter. Who out there is going to show you the nuances? When somebody tells you, you know, buy here, put your stop here, see if it works, there's no nuances included. And more than likely, that person doesn't understand the nuances. An awful lot of what we cover has to deal with nuances. This is a nuance, the poor low, the overnight inventory being short. This is a nuance when we talk about the spike. It is really what makes a difference in the success of most organizations or people or traders is a combination of really being involved, really being present, but being able to be exposed to and see and apply the nuances. Okay, Julia, that you know, I've kind of wrap it up there for my blah 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 portion of it. Let me take as many questions as we have time for.
Okay, great. Oh, people are commenting, agreeing. Where would your entry be? And you talked, this was at the beginning, Jim. Can you, your first trade you went over, C period.
Okay. Here, this is something that always confuses people. And it's like, well, where would you get in and exactly where you put the stop? I don't even remember where I got in. I don't know, something in my mind tells me it was 38.50, but I'm not sure about that. It may have been higher. When it spikes up here, I'm just saying I'm getting short. I'm not looking at an exact spot. I don't have an exact spot to get in. I'm going with the flow of the market. Now, this was one of the elements that I didn't share with you that I do to make it somewhat easier. I have a tendency to do a lot of trading against puts and calls. I came into the morning and I was I had calls, I had puts and I had calls, and so I shorted against I believe it was the 2440 calls. Or it may have been the 35, maybe it was the 35 calls and they were in the money. So it made it an easier short. But even if I didn't have that, I don't look at exact places. If the trade is right, a few ticks isn't going to make a difference. Okay, other questions?
Wasn't the A period high weak? It was one tick below the overnight high?
Yeah, I think that's, I had seen that. When I talk about chunking in the morning, it not only was one tick below the overnight high, it was just a couple of ticks above unchanged. So yes, it would have been considered weak, but it's a single data point. And so early on, I was aware of it, but I became more conscious of it as the AB low was matching. But good question, good observation. And when we talked about chunking earlier, that's something you should be able to walk into a market and see that immediately. I can walk into a market that I haven't traded, put up the profile, and I will see those things immediately because I've trained myself to see those. So that's a good point. It's a great observation, and it did come into play. Thank you.
Okay, Jim, weren't you tempted to hold that end of the day long that went exactly to half back with the 4 periods mechanically within 1 tick of each other above it?
No, remember what I said. I was holding it when it went exactly to half back. And it didn't, I didn't have, I really wasn't too concerned about getting out. When it went a couple of ticks above half back and there was nothing there, I was out immediately. It was market order out immediately, and I never gave it a second thought. One of the things that you're going to find where you want to get to mentally when you trade is once you have done a trade, you're not going back. That trade is over. That trade is past. There's no whining or carrying on. Boy, if I'd have just stayed with that, etc. It just doesn't make a lot of sense. I got a great story. I had a guy years ago, and some of you heard this story. He came to me and wanted me to help him learn to trade, and he said, he'd share any of his finances with me. Well, it turned out he didn't have any, but other than he did own a condominium above Carnegie Hall in New York. So he had some assets, but he didn't have any cash. So anyhow, one of the things I told him, I said, I don't think you're going to make it as a trader because you're too emotional. I forget one year he broke 10 or 12 monitors throwing them around. But the other side of the coin is he made $1 million plus that year. And it looked like I was really pretty silly. Well, he made it he actually traded 5% of the volume of the CME that year. But then it came undone. The smart thing he did, he took money out. He invested in some films he saw at Sundance. They worked. He invested in a cosmetic company that worked. He tried to go back to trading many times, and he could never make it. So, in that long term, it wasn't there. It is very important. Once the trade is over, it's over, and you don't look back on it. Very important. Okay. And then people ask me, how do you get there? I don't know how you get there. I was a crier and a whiner and everything else, and just sometime one year I just woke up and I knew that it didn't make any difference. I don't know where the line was that changed. Okay, other questions? But that was a good question because these are the kind of things when you start agonizing over these things, then you tend to make mistakes. When time goes on and it's not taking it, get out. If it goes through and takes it, so be it. Okay, other questions?
Is the JKM low considered a poor low?
The IJ low would be a poor low because there's no excess on the low. Definitely a poor low. But remember, sometimes poor lows are one data point, but poor lows occur when markets are too short. Poor low occurred here. Why? Market was too short. Poor low occurred here. Market was too short. Got a nice rally. Sometimes a market has to rally before it can break. In other words, you have to get there's too many shorts. You have to get the shorts out of there before the market can break. The market here had to rally before it broke. You had to get the shorts out before the market could go lower. And this afternoon, I think there's potential for the same thing, and that's why I didn't have a terrible time taking on the long down here this afternoon.
Is this bearish as we found acceptance in the spike from yesterday? Maybe you can make your screen a little smaller so they could see the spike yesterday.
There's yesterday's spike. No, I said early on it was bearish. I pointed out early on that we got acceptance in the spike. And then I said the next thing that made it bearish for today was that value was building down there. So absolutely, that was great information for how to trade the day. And today value was lower, and it was a day that, you made most of your money today, selling rallies. You take profits on breaks. I did this a little differently, but no, that was it. But now that's over. Now you get in, and what happens? Let me go back and look going forward. Okay, going forward, I don't know what happens. We finally had, over on the 9th, we had an all-time high that had no excess. It was a poor high. We continually talked and wrote about the fact that the long-term auction probably wasn't over. And of course, the market did come back, take that out, and it left a good high with 2 ticks. 2 ticks of excess rather than no excess. However, it's not a right home wonderful high. We have a very prominent point of control here that hasn't been revisited. We have another prominent point of control from the 20th that hasn't been revisited, which are important things that we carry forward. So the market is lower. The market's lower, and it's lower again today, but it's not one of those things that is clear that we have the high that is put in. Right now, is the market going lower right now? Yes. And we go over one of the things that we always do as we prepare. We always start, when we do our reports in the evening, we always start with a bar chart. We start with a monthly, and we use the monthly in order to get some perspective of what the market looks like from the longest term. So I think it's this 7 months, the market's been one time framing higher on a monthly basis. The settle today is right in about the middle of the month. Once we do that, this is to give us the bigger picture, and then we work to the smaller. Then we look at the weekly. Okay, when we look at the weekly, we look and we see, and this is interesting because I haven't done the report yet for tonight, but we have 3 weekly lows that are almost fitting a trend line. So there's the potential for a firecracker effect on the weekly. What is the firecracker effect? The firecracker effect is just a term I came up with that kind of just, oops, I'm sorry. It's just a term I came up with that hit me one day that describes what happened.
Just spread it out a little, yeah.
When you get, and these lows aren't quite low enough, not quite close enough to be there, a little bit more tomorrow and it would be, but when they've kind of perfectly fit a trend line, then you come in one day and all of a sudden, one set of stops hits another set of stops, hits another set of stops. You want to see what it looks like? Here it is right here. That low was close. This low was close. I'm sorry, the low, one close, and at one time, this low was close. So you had these 3 lows lined, and look what happened when it took it out. That's what your firecracker effect looks like. We're getting to that possibility here. I'm not ready to, be that cognizant of it, but I'm seeing it as a potential. So we look at the monthly, then we look at the weekly. Again, when we're going down to the smaller, then we look and see what do we have on a daily basis. And when we look at the daily bar chart, we see that, okay, we are one time framing lower on the weekly bar, on the daily bar, but all of a sudden, and notice that these kind of fit, but when you look at these lows, these highs are also susceptible to a firecracker effect on a market that rallies. So, I mean, you got to remember, this works both ways in there. Here's another one over here. You took out these lows and away it went. Anyhow, it's not absolute. It's just another way. So we look at the monthly, the weekly, the daily, and then the next thing we do is we look at the profiles, and to get a better perspective, the profile gives you a microscopic view of what's really going on in the very short term in the market. But we always look at it from the top down. And the reason we look at it from the top down, so we always have a broader perspective. If you don't do that, it's so easy to get lost and say, well, one day is down or one day is up, and you start thinking that that means the whole market's up or down. When you start with the monthly, weekly, daily, before you go to the profile, you have a much better perspective of what's going on in the market overall. Then we come down to the profiles, and then we try and put that, start from here and put our trading plan and our scenarios together for tomorrow. Other questions?
Yes. Is today an example of a market getting too short or short in the hole?
I don't think so. I think it had that potential this afternoon. It had that potential. And when I look at these highs fairly close together, it's got the potential. But you have a poor low, and the point of control did come lower. Had the point of control stayed up on the upper end, I would have said that was a greater possibility. Right now, I don't see it as being too short. But with all that said, I'm still aware this has not been a really healthy break in the market. But yes, I'll think about that, but I do remember we are one time framing lower on the daily basis, on the daily profile. I have a very prominent point of control down at the 24, 26, 75 level that's never been revisited. And that's very much in my mind also. The ones above are, but so is the one below down here. Okay, other questions? Your mic on or off, Julia?
I beg your pardon. How many points do you need to consider a price probe out of range a spike? So if we're looking at June 20th, for example, that's the most recent spike you wrote up. She's curious.
I don't have any direct answer. People love, direct answer. I don't have it, but I can just, when I look at this, I just see it was enough below the previous day in order to be, very clear and visible. I try, if something doesn't jump out at me, if I have to force it, if I have to force the observation, then I don't worry about it. I want to be able to look at the market in a relaxed way, and I want to see it. When I look at this, I don't have any trouble seeing it. So again,
Right.
but I don't have nice, neat, direct answers.
And on June 15th, for example, we see that L, M, and N periods, the end of the day, did probe out of the existing range until those periods came on. Do you see it? It's June 15th. Just point to it. So, I mean,
but I would never
consider that. I'm just giving her an example. So we wouldn't consider that a spike. You want to see something more like, we saw on the 20th.
Here's what, let's say the market would have closed here. Here's a late price probe. Had it closed down in here, we would have looked at it. Closed up here, so we didn't really look at it very much. But, you're looking at something that you don't have to force the observation.
Jim, how do you incorporate volume analysis along with the TPO analysis?
I don't do TPO analysis anymore.
You
TPO
mean
no, well, you said, how do I, oh, I'm sorry, I thought it was TPO analysis.
TPO versus volume constructed profiles, like where does volume, how do you, incorporate them together?
Okay, well, first of all, let me say that when I hear TPO analysis, historically, in the early days, we did TPO analysis, was to measure if the floors were long or short. Since there's not much trading on the floor anymore, we don't do TPO analysis anymore. When we then when we come and we talk about volume, we use the volume generated by the New York Stock Exchange in order to determine a volume. So let me go here. We use the NYSE volume. Go to our training site. and then we look at NYSE volume, and we see that today's volume was 3.5. So that's what we do. We look and see what was the market attempting to do today and how much volume. If you don't have a clear direction, if you don't have a clear direction for the day, then we don't use volume. We only use volume when it's clear what direction the market was trying to go. Now, the next thing comes up when people are talking about volume. Some people use a volume point of control, or POC or POC. We don't. We use a traditional TPO, our point of control, and we do that because it incorporates time. The volume POC or POC does not incorporate time. We think time is extremely important. Price advertises opportunity. Time regulates all opportunity, and volume measures the success or failure of the opportunity. To take time out of it, we think is a mistake. So when we're looking at that, we use the TPO reading from left to right the longest. Now, I do look to see what is point and control. When you're talking about what's really going on, we look to see the migration of the point of control, and the migration of the point of control, the theory being that the longest line reading from left to right is where you had the most prominent trade to date. Prominent when you combine time, price, and volume. So we do look at it that way as part of our analysis. Okay, other questions?
Yes. What's Jim's opinion on going short at the G high with the expectation that they will likely sell mechanically off the rally, like in E and F periods, and having a tight stop a few ticks above the D high? So he's, yeah, go ahead.
Okay, one of the things that's so important is we understand that, you know, we may trade one way. I trade quite differently than Julia trades, and most of our clients trade quite differently than either one of us. And sometimes that makes it difficult. A lot of traders come in, and no matter what we say, they're intent on trading multiple times a day. So one of the things that we've tried to do in the latest educational programs is break things down between fast trades and slower trades. Not always, but generally I'm a slower trader. I'm looking for a couple of trades a day that I think have a little more potential, a little more, you know, range to them. I don't always do that. Today I was doing some fast trades today, but that trader, the slow trader, is looking for a couple of trades a day. The fast trader is somebody that's looking for a series of short-term hits. The first thing that I say, if you are going to be a fast trader, you have to examine your personality. And your personality has to be one that can change your mind very quickly, that you have a lot of mental fluidity to it. So now let's go back directly to the question that was just asked. To short the G period high is not a good trader, not a good trade for the slower trader, although the trade worked, but that's not the objective. It's a good trade for the fast trader if they want to do it. And what that means is if you short at the G period high, if you get up above to the D period high, you better be out and be out very quickly, because you can hit the G period stops, F period stops, E period stops, D period stops, and that market can run to the high very quickly. You hit the stops triggers momentum, the momentum brings in more. So again, the answer to this question is, to one person, I'd say it's a terrible trade. To another person, that, you know, they're very fluid in their mentality. They can, the trade doesn't work, they're out, and it's bygones. They don't think about it, they don't whine about it. So again, depending on who the trader is, depending on the personality, tells you if that is a good trade or a bad trade. Okay, what else we got?
Does Jim take market or limit orders when he lets the trade come to him?
I am almost always market orders. If I want to do something, I'm really not worried about a couple of ticks. So most of the time, I am using market orders. I want in, I want out. A lot of times, I don't even know what price I got in or got out of. I want the trade, and I'm going to do the trade. Okay, other questions?
Did you see a 45 line developing today in DE and F period and then a failure or lack of a breakout in flush in G? Or did you look at it just as random?
I looked at it more as random. I mean, did I think this market was getting too short? Yes. The POC moved down. It was here where it's gold, here, and then finally ended up here. So it did move down, but it did look like the market was getting too short. There was a 45-degree line for those that are new to us. It just means that the fairest price is up here. And when traders are shorting consistently below that price, they are selling at prices below the fairest price, or they're getting caught short in the hole. Now, this works both from the long side and from the short side. The last 2 days, we have had the 45-degree line going upward, not downward. So when it's upward, the last 2 days, we've had traders getting too long at poor prices. When it trades below it, then you have traders getting too short at poor prices. Okay, any more? I think we're at about the end of it, if I'm not mistaken. Any more questions, or I'll do a wrap up?
Yeah, we had a question to look at crude and the NAS, but we're kind of tight for time on that.
Let me do the crude very quickly. Let me do the NASDAQ. I'll do the crude for a second. The crude oil
bonds.
I'm sorry.
It's right there.
The crude oil, it's just, the trend is down. You got a breakout. You got the break. You got the market balanced. You got another break. You got another balance. You got another break, and it's down. There's no clear sign of excess yet. But I do want to very quickly cover the NASDAQ, because the NASDAQ was very interesting, and I had several comments about the NASDAQ today. And the comments were that you had a poor high here. At one time today you had a poor high over here. So you had two poor highs. This high was kind of weak because it's so close to this. And I was watching this all afternoon, and like putting out, it looked to me like we were going to get an upside breakout in the NASDAQ. And the NASDAQ was stronger all day than any other market. Look at the value. The value was building higher all day on the NASDAQ. So the NASDAQ, so you've got an upside breakout on the NASDAQ. Now for tomorrow morning, what you've got, and I used the term go, no go this afternoon, and incidentally, you've got several things. Here you have an upward spike. You have an upward spike in the NASDAQ. So the spike trading rules that we talked about earlier are in play for tomorrow. You have a support level at the, I'm trying to move my, at the 57.83 level. So this is kind of a no-go level. So you broke out above what's about 6 days of a trading range. You broke to the upside this afternoon. You have a late price spike. So you're looking at the price spike to look at. So remember, opening above the spike and staying there is bullish. Opening below the spike is staying there is bearish. And then trading back below these highs, suggests that you have an upside breakout failure. So it's a pretty important level for the NASDAQ tomorrow. Okay, anything final?
Well, I just want to address this last question. You talk, we are talking about mental states. How did Jim overcome all the scars? I have trouble pulling the trigger, years of not getting it right each time. And I'm sure he's not alone in inquiring. So before we
Yes.
sign off.
One of the things I read an email a couple of times this week to our audience from an individual down in Texas who had given up trading for a while. And he talked to me one day about some of these mental problems. And one of the points I made is you will be surprised if you do your homework and prepare your scenarios every night and really focus on structure rather than price, you will find that about 90% of those emotional problems will go away. In his email, he said he scoffed at me and he went about his merry way, quit trading. He came back sometime back, just not too long ago, and he went over all of that. And he started really understanding structure and the market and doing his homework and scenarios. And he said he can't believe how right I was, that so many of the emotional problems, he's now relaxed. They don't even come to his mind. So I think you're going to find, like anything else, the first thing is most of the people that have a lot of mental problems trading are price-based traders. Price is nothing but an advertising mechanism. It's part of the auction process. Any auction process is designed to sucker you in. I mean, that's what they do. You go to an art auction, they get all the enthusiasm. So it's designed to suck you in. When you start looking at structure and start to really understand structure and the importance of it and value, then you get a whole different perspective on the market. Then when you do your homework and do your preparations and rehearse your scenarios, I believe that it will help considerably in the execution and in the anxieties that we have as traders. Let me sign off by talking about the intensive coming up. Our commitment, it starts on July 2nd. And once you sign up, you start getting the reports immediately, even though it's not July 10th it starts. You get all the reports 2 a day between now and then, and you get the chat comments in order to give you a chance to warm up to it. Now, there will be no chat comments next week. There may be a few on Monday, Tuesday, but there'll be no chat comments Wednesday, Thursday, and Friday because deep sea fishing is on the agenda prior to the start of the second intensive. But to get the reports, you'll get chats along the way to get you ready. Our commitment, I mean, the best we can do is give you everything we've got as part of the mastery program. We don't hold back. We don't hold back secrets. We try and expose you to everything we think is important in the market. And the chat comments throughout the day, try and uncover a lot of the nuances. And successful trading is about nuances. First, you need the foundation. You have to break yourself from price. Then you need the foundation. You need to understand structure. Then you need to understand the nuances. Then you need to prepare. The promise that we make to you, we will give you everything we've got to give you as fair a chance as possible to become a successful trader. And Julie and I both make that promise to you. Let me say thank you very much, and I do hope that more of you will join us for our final Mastery Series program. Thank you very much.